Let's go. Let's do it. You feel that Friday vibe in the air? I certainly do. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. Today is Friday. Sources familiar with the situation have confirmed it is Friday, January 20th. I'm JD. January 20th to me is like inauguration day. Obviously not today, but that's what that date usually triggers in my head. I'm JD Durkin. We're about an hour into the trading session. Stocks are trading higher. This is the streak, comes off a 3-day losing streak as corporate earnings and a whole bunch of economic data spark concerns about the health of the U.S. economy. Taking a look at what is on tap for this morning's broadcast, we will talk Fed because we always talk Fed here on this show. We're nerds for the stuff, folks, as the central bank continues its hawkish stance and hawkish comments from various Fed officials. We'll also hear from a few more Fed officials on the record for the last time before February's FOMC meeting. Plus, we will be recapping Netflix's earnings after the streaming giant reported better than expected subscriber gains, but also making headlines with regards to some succession planning, perhaps. And finally, we'll bring you all the details of the latest tech layoffs as Google set to cut 12,000 jobs. For more on those stories and so much more, we now bring in Mr. Martin Baccardax, our senior markets correspondent. Martin, good morning. Happy Friday.
Good to see you, mate. It's an interesting one, isn't it?
It is. So talk to me about why you think it's so interesting. This is the sort of week we pour over economic data that maybe in traditional cycles we don't pay as close attention to. We're all trying to see where the puck is going here. What do you make? You want to start with the Fed? What do we make of the Fed comments? Because whether it's Lael Brainerd or Susan Collins up in Boston, I mean, they're all, it's not that they coordinate messaging, but they all seem to be on the same page, higher for longer, north of 5%, and that's what we got to do to bring inflation down. What do you make of it?
Yeah, well, I really like your analogy about where the puck is going, JD, because I think that's exactly what markets are trying to anticipate right now. And in some respects, we are seeing just snippets of that from the language out of the Fed speakers that we've experienced over the last sort of 24 hours. I'll go to Lael Brainerd, who's the Fed vice chair, and obviously, as a result, a significant influence with respect to monetary policy. What she said yesterday, or perhaps what she didn't say, was really enlightening. What she did say was that the Fed is probing to discover where it needs to get to in terms of an overall rate that would tame inflation and avoid recession, that so-called soft landing. She did not say that that rate would, as a result, be over 5%. Now, that doesn't mean that it won't be, but she may have been specific in not dictating that level of Fed funds target. And as a result, she may be offering some kind of capitulation to the markets, which of course haven't been pricing that 5% plus rate in for a number of months now. She also sort of intimated that the February rate hike can be at that 25 basis point level. CME Group FedWatch now is pricing in something around the range of a 95% probability of exactly that. But I do believe that because we are seeing increasing evidence of potentially a bottom in the housing market, certainly a downward trajectory with regards to inflation, some complications in the job market, it has to be said, but a broader sense that recession risk is accelerating, all of that is very likely to get the Fed to at least consider changing the trajectory of its rate path. Whether or not that means a pivot, of course, is many months down the road. But nonetheless, we're seeing those incremental movements towards a change in thought. So to your analogy, JD, I really do believe that markets will be very quickly focusing on where that puck is going to be rather than where it is at the moment.
So it sounds as if the CME Group puts, what was the percentage for 25 bips?
Somewhere around 95% at this stage.
I mean, I wonder why I keep hearing so much chatter. Maybe it's just analysts who want to see more of a jumbo rate hike up front and then would like to see the central bank kind of settle down for a bit. But what happens if it's 50? What happens if we continue with 50?
I think there'll be too much dislocation for the Fed to risk that. I mean, quite frankly, JD, you cottoned onto this many months ago, and I think that the market has been slow to take up the sort of messaging. But you were one of the first that I heard sort of really understand the stress that the Fed was taking to explain that it's not about the pace of rate hikes, but about the ultimate destination. And as a result, there needn't be that over focus on the size of hikes at individual meetings. And I do believe that's likely to bear fruit. There are still some recalcitrant sort of analysts out in the market who are pushing for that argument. In other words, get the rate hikes over and done with, and then we can begin concentrating on other facets of the economy alongside corporate earnings. But the Fed simply isn't going to play along with that, even if they were to change the trajectory of their ultimate rate destination. But at the end of the day, JD, I think you were correct a long time ago in saying the destination is far more important than the pace that we get there to.
Yeah, I was also rewatching. I guess this was Chairman Powell's most recent press conference after the last FOMC decision, and one of the questions he was asked was, "How do you know when you've gone too far?" And I didn't catch that question the first time that I watched it. I rewatched it last night because that's what we do. We go back and we rewatch old press conferences for fun, especially if there's no football on. And Chairman Powell says it's hard to know when we've gone too far.
Yeah.
The focus continues to be on ongoing rate increases. So is there anything you think the central bank has at its disposal to say, oh, oops, okay, I know we probably should have begun this process sooner, but we didn't. Now we're locked into this trend. How should they know? How might they evaluate? Let me ask it that way, to know whether or not they've done enough work here.
No, I think you're right to point that out. It'll be very difficult. It's an art, it's not a science. There's absolutely no question about that. But I think the Fed's overfocus, if you will, on conditions in the job market, and that's not necessarily a policy error because, of course, it's one of the twin mandates that the Fed has to execute, is sort of leaving them in a bit of a tricky situation because they may not fully understand what the job market is telling us about the broader economy until it's too late. And by that time, of course, it may be well past time to have taken the foot off the gas with respect to rate hikes. So I don't know that we actually will sort of understand whether the Fed has gone too far until it has gone too far. There will absolutely be a little bit of 2020 hindsight in that assessment. But I think the focus on the job market does make their job incredibly difficult. I mean, we had that surprising decline in weekly jobless claims yesterday. We're seeing, obviously, tech layoffs accelerate across the board, but at the same time, there are allegedly loads of unfilled positions out in the economy at this stage. December non-farm payrolls were very firm with declining wage growth. So you can cherry pick a point of data inside the labor market mosaic and come up with a different argument each and every time. So as a result, the Fed, I think, will find it difficult to get a cohesive vision from that. And that, to some degree, and I think to your point, raises the risk that they may go too far, potentially without wanting to do so.
Mark, we know that growth, unemployment, and inflation must all be in some degree of balance. There must be some harmony for an overall healthy economy. And we know that really the main challenge has been that these numbers have been so badly out of whack since Q1, especially Q2, back in 2020, when you look at how quickly GDP fell and then aggressively rose, skyrocketed in Q3 of 2020. And since then, we've been just trying to find that sweet spot, right? That I think you used the word Goldilocks. Sometimes that not too hot, not too cold number of GDP. We're always kind of going for 2 to 3%, but this idea of below trend growth is something Fed officials say that they're actually going for. So they want to see that number south of 2%. The job picture does complicate this quite a bit, and we've heard from Fed officials saying that a softening of the labor market is one of the things that they are going for. How big of a challenge is that, especially keeping in mind that unemployment figure that we saw go down to 3.5, if I'm not mistaken, a few weeks ago?
Yes, I mean, that's kind of what I was illustrating just in the last answer, JD, in the sense that there is that complexity that makes the Fed's task incredibly difficult. And I'm not entirely sure that we're going to get the clarity that is needed from the job market for a number of months now, or a number of months forward, actually. Maybe these tech layoffs are going to indicate weakness in business investment and in consumer spending and all the rest of it that might accelerate that process. But I really do believe that the COVID pandemic created such a sort of a unique event in terms of labor market history that we simply can't with any great confidence understand how that is all going to shake out. There's going to be a number of people who have left the workforce altogether and may have permanently decided not to return. That, of course, is going to have incredible implications on those who are coming up underneath to fill the positions that those retired workers had typically done in the past. Now, whether or not the gap between that need and the pullback that companies are likely to make on hiring going forward is going to find an equilibrium, anybody's guess. We'll find out again in a few months' time. But I was reading some interesting analysis yesterday, which indicated that as companies become more uncertain about the economic conditions, they tend to slow hiring before they start firing. So as a result, the claims numbers, i.e. those that are looking for jobless benefits as a result of being let go, may not materialize for a number of months. So company X sees the potential for slowing demand in the next 3 months. They freeze hiring for 2 months, and in the third month, they start letting people go. Those workers might not decide to file for unemployment benefits for another 2 or 3 months. So the result of firing or the result of uncertainty in January might not be expressed until June with rising claim numbers. And again, by that point, the Fed may have already executed the rate hikes that will choke off growth in the economy just as more and more people are out of work and companies are accelerating their spending pullback. So that's the timing sequencing, I think, to some degree, that investors are trying to discover, but it illustrates how complicated the labor market situation is at this point.
And how much more complicated could this be? This is additional analysis that I was reading just a few days ago by the fact that if you talk about these big tech companies that are issuing this layoffs, and obviously we got news out of Alphabet and we've tracked the numbers from Amazon, Salesforce, oftentimes these employees who are losing their jobs, which again through the lens of just basic humanity no one wants to see, despite the Fed's unenviable task here, oftentimes they are being issued severance packages where these are 6, 8 week, 12-week packages. So maybe there's that sort of delay in early unemployment claims, especially if a lot of these employees who were, white collar, very high income earners, now are still, in essence, still able to earn and spend, even if they no longer have that job.
Not sort of homogenous in the sense that the people being let go at Amazon aren't necessarily going to turn around and find a job at Google and vice versa. But there is, to some degree, an element of higher skilled workers who are being and their ability to find another job rather quickly compared to those at the lower income scale. And that can mitigate exactly what you're describing as well, and mitigate the fact that unemployment benefits rate may not reflect exactly what's happening in the job situation. So again, that timing, and maybe to some great degree, it's why economists say that those job numbers are a lagging indicator of economic performance. It's absolutely true. But I do think there's something to what you say, and as a result, again, just adds another layer of complexity.
And no shortage of complexities and cross currents, right? I mean, my goodness, every day there's like something new to pay attention to. I do want to ask you about earnings, and we can start by either looking at the week that was, or we can give a preview to move ahead. But do you want to hit Netflix here? Because obviously there's succession planning headlines, and there's a broader. Okay, so what jumps out to you? Obviously, we've got the Reed Hastings headline, which I would argue kind of steals a bit more of the energy versus the subscriber growth numbers. But one or the other, which one do you want to start with, and what do you think is most significant this morning?
Well, I'll fully confess, JD, that I simply don't understand the market reaction to any of this. And I've been digging through it, and I don't find myself with any greater clarity. Typically, when you have a situation where the founder of the company, a pioneer of the sector and the driving force of the company's image decides to step aside, you're not going to see the stock pop as a result of that. And that's exactly what happened. And this is absolutely not investors thinking, oh, great, we've got Mr. Hastings out of the way, now the company can grow. Absolutely not. There's now a significant risk with respect to leadership as a result of the void that he's going to leave behind. Furthermore, I thought we were in the position, JD, where we didn't care about subscriber growth anymore, and we were all about profitability, because adding new subscribers is increasingly expensive. Content costs are only continuing to rise. There's tons of competition. So for a streaming group to be out there culling in new viewers without adding to profit margins or profitability isn't what investors were looking for. And to that point, Netflix missed the street forecast for its bottom line earnings by a mile. It was down at around 12 cents per share. The street was looking for something around 44 cents per share. And this is down about 90% from the same period last year. The revenue growth, JD, was the slowest since the company went public in 2002 and only just met Wall Street expectations. But here we are. The stock is well higher. It's 55% higher than it was 6 months ago. They have some significantly, I would say, optimistic forecasts for free cash flow. They see margin improvement and they see relatively solid earnings. They didn't give us a guidance on subscriber additions, because they're not going to do that anymore. But I do say, JD, I'm mystified as to this reaction. I think there's a ton of questions with regards to Netflix's near-term and long-term future. And, I guess I'm going to have to go with the market consensus, because these people know a lot more than I do. But to this point, where we sit right now, I don't fully understand why the stock is as firmly higher as it is today.
Outside of having a very strong quarter, which I think in terms of some of those subscriber numbers people were looking for it to be, it's still the worst subscriber growth year that the company has had going all the way back to 2011. So it sort of goes, it reminds me of the conversation we have about tech layoffs, which is, you've got the short-term headline, but if you're able to take a step back and look at it in terms of, yes, Amazon is laying off workers, but how many did it add from the second quarter of 2020 until now? So there's a little bit of a bigger picture perspective, and I think that needs to be applied to Netflix. Like this was still not a good year by Netflix's standards. For whatever it's worth, the breakdown I was able to understand is that Ted Sarandos will lead the kind of Hollywood effort, the wheeling and dealing on the deals and the handshakes and so on and so forth. Greg Peters will oversee this newly announced ad business as well as password sharing, and Reed Hastings will still serve as executive chairman and a major shareholder. So perhaps there's a sense that, all right, if Netflix is in a position in like the M&A space, that he would still likely be involved. I don't know that that's the answer as to why we see the reaction, but I don't know. What do you make of it in terms of potential succession planning versus what we've seen companies for like Disney? I mean, it seems like a vastly different approach, and also keeping in mind there's a long history, as we saw with Disney, of former CEOs coming back, right?
No question about it. And they came back as a result of the new CEO not being able to engender profitability from the streaming division. Bob Chapek was pushed aside. Bob Iger, who effectively pioneered it from a Disney perspective, had to come back in and effectively say, we're not chasing subscriber growth any longer. We have to make some money on this. So yes, I think you're right. There are going to be questions about sort of the longevity of this new co-CEO pair. Now, I would just say, and again, I'm going to editorialize a little bit. If you are co-CEO working with the founder of the company and effectively the most influential person in the streaming business, you can be comfortable in that position. If you are co-CEO who is now sharing responsibility with someone who has just been elevated, and in point of fact now operates two of your company's most important growth drivers, tech and advertising, suddenly the dynamic becomes very different. So Ted Sarandos, I think, is going to find himself in a very different position with Greg Peters to his left than he did when he was sitting to the right of Reed Hastings. And we only have to look at Salesforce, JD, where Brett Taylor was co-CEO for just over a year with Mark Benioff, and decided, I don't want this. I want to go out and do my own thing. I don't want to be second banana to somebody with a much greater, sort of market and public life profile than I do. So it does raise questions, at least from my perspective, as to what the leadership team is going to do at a very challenging time for the company. It's rolling out this password crackdown. It's dealing with intense competition. It's going to somehow try to keep its content spending in check. And we can't forget, JD, that the specter of net neutrality continues to hover over the whole of the sector. Netflix, from a video perspective, is responsible for the biggest portion of internet traffic in the world. And it doesn't pay any extra for that than if you and I were to set up a blog and put it out into the world. So you can imagine European regulators are going to take a closer look at that. when a company is expanding at this rate. And net neutrality hasn't gone away as a potential political issue here in the United States as well. That's obviously a long-term risk. Competition is a midterm, and growing that subscriber base whilst you are trying to get your ad platform expanding and cracking down on password sharing at the same time is probably the most near-term risk for the company.
Yeah, to the point about overseas, obviously the company has looked to make tremendous strides in Latin America, in the Asia Pacific region. We know that India has been a bit of a challenge for Netflix. Others have had more success in the space, but I didn't see all the guidance too closely yesterday after the bell to wonder. But obviously, those will continue to be priorities for the company here. Okay, anything left on Netflix for you before I ask you about Google? Because I do want to move on, but this is such a big one that I mean, especially actually, let me ask you about this ad model. Did I get your take already on this ad model attempt? Because I feel like Netflix for so long says we're not going the ad model route, and then they very quickly pivoted with intention to say we are going to go. But I'd have to imagine part of the ad model is to get people to buy in at the $7 level, get them kind of hooked on the product in the hopes of a full subscription. I don't know. That's kind of my read. What do you think?
If I were a betting man, JD, I would say that they accelerated the launch of the ad model to make sure that it was in place prior to them cracking down on passwords. In other words, they feel that there's about 100 million users out there who aren't paying anything for the content. Now, once they crack down on password sharing, they want to ensure that those 100 million users stay on the platform in some way. And if they can be enticed into a cheaper option, the ad-based platform, they may be able to retain more of them. That's just my interpretation of it. But I see the sequencing as being very closely aligned. They said it's far too early to judge the success of the ad-based platform just yet, but they like the product use and they think it has good potential. So we'll see how those two issues dovetail, JD, because I do think they're very closely connected.
Yeah, absolutely. And of course, Netflix does have great shows, right? I mean, that's why they're top dog. They were kind of first into the streaming space. They got a lot of great content out there. They make a lot of in-house content that does kind of get ridiculed a little bit. I mean, they also do spend a ton of money on these blockbuster movies that no one's ever heard of with like super A-list superstars. I don't quite understand the financial mechanics of it, but then again, I'm not a chief executive at Netflix. All right, let me ask you here about Google, the latest tech giant here to cut staff here. 12,000 jobs. What are the details, Martin? What do we know?
6% of the workforce, and it came a little bit out of the blue, even though most analysts assumed that once we saw similar cuts from Microsoft, Amazon, Meta, and others, that Google wasn't too far behind because, of course, it's the biggest online advertising firm in the world, and as a result, isn't going to be inoculated by the slowdown in spending that we experienced in the last part of last year, and is very likely to extend into 2023 and possibly beyond. Essentially, the cuts are going to go across the whole of the business, some in engineering and product, some at the corporate level, but we're not entirely sure where they're going to fall in terms of percentages across the different Google groups. But nonetheless, it's a pretty significant cut. I think Morgan Stanley estimated that Google could save somewhere in the region of $4.2 to $5.2 billion as a result of these. And this, of course, factors in the severance payments and all the rest of it that they'll have to extend to these people who are being let go. But ultimately, again, from that sort of vicious spreadsheet analysis, this has been positive for Google stock. Investors think it's going to carve a big chunk of their expense base, which has been an overhang for tech for the past couple of years, and again, just sort of extends that significant cull in headcount that we're seeing from a very important space, not only from a financial markets perspective, but an economic one as well.
Yeah, of course. So that's certainly an important story there to lay off 12,000 workers, 6% slash to the global workforce there. To what degree can you or do you not? I mean, I'm just looking here. This is also Facebook parent company cutting 11,000 jobs. I mean, obviously it becomes very easy to kind of group this in. Do you think there are unique conditions to Google, or do you see this more or less as a continuation of a lot of these stories you and I have been talking about for quite a while?
I see these as more in parallel with what's happening at Meta than what's happening at Microsoft. Google, of course, and Meta are two companies that are, well, they're the two biggest online advertising sort of machines in the world. So their stresses are going to be far more parallel than those from Microsoft. So as a result, I see a lot more similarity in there. Meta's costs are, of course, complicated by the money that it's pouring in to the metaverse division and the red ink that portion of the company has bled over the last sort of 9 to 12 months. Google's a little bit different. It's so reliant on ads, and its other bets divisions really don't generate enough profit or loss to sort of change the overall game. And that's the fact that search and YouTube are absolutely the biggest shows in town, if you will. So I see those more in parallel. I see Microsoft job cuts as being more indicative of business spending pullbacks. We talked a little bit about this yesterday, but it bears repeating. I think when companies are hiring people, of course, they're going to be buying computers. They're going to be adding people, adding chairs, and as a result, they're going to be putting people in front of those computers. Those computers are going to need software, and generally that's going to come from Microsoft. A pullback in spending is going to lessen demand for that. It's going to lessen demand for the cloud services that Microsoft provides alongside of it. So when we see Microsoft job cuts and fading demand, I see it as more associated with business prospects. When we see job cuts at Amazon, I see them more associated with consumer prospects. And when we see them at Google and Meta, I associate them more with advertising spending than anything else.
I do want to ask you about the week ahead, both in terms of earnings, because I think we have Tesla coming up. But one point to an earlier conversation that we had that I actually forgot to ask, correct me if I'm wrong, are we expecting the fourth quarter GDP number next week for 2022? The final piece of that GDP puzzle? I might have my date wrong.
I think you might be right, actually. I think it'll be that final tiny revision, but I don't necessarily think that will be the game changer because the fourth quarter number is going to be firm in the mid 3% range. If we're 3.2 to 3.6, it won't really make much of a difference because it's in the rearview mirror. What might be important is what sort of momentum that can carry into the first quarter, but we'll understand probably better with respect to that momentum when we get forward projections from the companies that are going to report next week. And there's a collection across the board, and I think that's what's going to be interesting.
Yeah, and just one quick on the GDP. That is the expectation. It's supposed to be north of 3 again. That would be the second consecutive quarter. It would have been north of 3% after 2 consecutive quarters of negative GDP.
Yes, exactly. Well, I'm trying to remember. I saw Atlanta Fed GDP now just yesterday.
Sure.
I think it was around 3.3, so I'll hedge my bets on either side of that.
Fair enough. I forgot that I do believe we get that number in the next week. I believe it's Thursday, but we will we'll check and we'll certainly follow it very closely because I think that's
sure.
You're right. It's in the rear view, but it's still an important metric, I think, and one of many things that we'd like to talk about. All right, so to the point of earnings this next week, Tesla coming up big. We spoke with Dan Ives of Wedbush not long ago. He said that is the date by which he wants to see Twitter have a new CEO. I don't know that that's going to happen by the time we hear from Tesla. But outside of the EV giant, who else are you following for the next week? What should be on our radar?
Boy, we've got a lot of big names. Johnson & Johnson, Microsoft, IBM, Intel, Boeing, just all sorts of names across all sorts of sectors. And as a result, that's why I think next week is going to be critically important because we really want to understand what the companies are seeing in the front mirror, through the windscreen, in other words, like what their projections are over the near term. And because we're going to get them from such a broad group of sectors, it will give us a much better collective sort of understanding of where the U.S. economy is headed. So I think that will be absolutely crucial. I suppose Boeing and Microsoft, alongside Tesla, will be the three most important. Johnson & Johnson, I think, too, is one that cannot be ignored. And for that matter, neither can Intel because of its foothold in the chip sector. So it's difficult to pinpoint exactly what the most important number will be. But I should imagine that the Tesla number will have the most noise, even though it may not provide the most signal.
Yeah. Wow. Well, you and I are certainly going to have a very busy week next week as we get those numbers. Some will be before the bell, some will be after the bell. But don't worry, folks, to all of you watching at home, we will be here to break it all down and give you everything you need to know in preparation of and to help digest the numbers after we get them. All right, it is 11:02. Time now for our rapid fire section. We talk Eli Lilly from time to time. So first up, did Eli Lilly hit a snag, Martin, with its new Alzheimer's drug?
Yes, absolutely. The FDA says it isn't going to give it a rapid approval process. They want to wait for a little bit more data from a late stage trial. Now, this doesn't necessarily mean that they're going to reject it, but they simply want a little bit more information from what is a critically important drug for a really debilitating disease. Eli Lilly says, in fact, the lightness of the data was as a result of the success that it had in the phase 2 trial, and they're committed to putting in the full recommendation to the FDA sometime before June, and we'll see exactly how that plays out. Biogen is the rival in that space. Its stock is up today. Eli Lilly is down as a result.
All right, next up, number 2, unhappy holidays. Is Nordstrom in for a bumpy ride?
Yeah, I'm really surprised by this one. They had very weak holiday sales. They were down 7.6% compared to last year at Nordstrom Rack. They were down in the low single digits across the whole of the business. The company slashed its profit forecast as a result. There's some expectation from analysts that they're able to clean out their inventory as a result of some heavily discounted items over the holiday period. But the incremental evidence, JD, that we're getting from holiday spending is simply not good. And December retail sales, as we talked earlier this week, were weak alongside of it. So the consumer was definitely in pullback mode even over the holiday season, and that's being expressed in Nordstrom shares this morning.
Number 3, what is behind Costco's stock bump?
Well, that's the company that actually did reasonably well over the December period. They had much stronger than anticipated sales. And as a result, last night, they said they have authorized a new share buyback program, and they paid a 90-cent dividend. Costco is just a company that keeps firing on all cylinders, despite the conditions in the broader economy, as a result of the value proposition of their goods and services and really excellent execution across the whole of the business. That buyback plan is about $4 billion. It replaces one that was put in place in 2017. It probably won't get fully exhausted, but it's a nice buffer for shareholders as a result. Stock's getting a boost. We still have a long time before we get their quarterly earnings, but nonetheless, good momentum in the stock, and it has to be said, just a really good company.
And you did not mention the $1.50 hot dog soda combo.
I really should have. I actually have a related question for you when we talk NFL.
Okay, there we go. Fair enough. On to number 4 we go. NFL divisional round. Who you got? Don't break my heart, Martin.
I don't think. You know what? I'm rooting for you guys. I think it's going to be. People are saying that this might be the game that offers the least in terms of competition, but I disagree. I think the Giants are one of those teams, JD, that doesn't do anything exceptionally well, but does a bunch of things just well enough to make them very difficult to beat. So that's going to be a lot of fun to watch.
Well, I like that a lot. That's a great description for the Giants. Not just this season, not a whole lot they do really well, but like every once in a while, like they do just enough the right way.
Exactly.
And are there any of the other games you are excited for? I mean, I feel like Dallas, San Francisco is such a legendary matchup, and you just can't discount the AFCs. Yeah, it is.
Yeah, that's got such great historic context. It'll be a lot of fun to watch. Brock Purdy being a young star going against Dak Prescott, who probably had his best game in his career last week. Obviously, Cincinnati, Buffalo will be a battle of two tremendously talented quarterbacks. Will be a lot of fun to watch. And I'm really wondering whether or not we can see some of that Trevor Lawrence magic resurface when they go out to Kansas City. I was looking at the slate of games for the weekend, JD, and I just thought to myself, every single one of them has an entertainment component that will keep people watching. And you can understand why online streamers, why broadcasters, and why everybody else wants to get a piece of the NFL, because when it comes to sports entertainment, it's really second to nobody.
Yeah, very well said. We talk a lot about the digital distribution, the shifting landscape underneath NFL, Amazon. We're almost out of time, but real quick, since we had the first year with Kirk Herbstreit and Al Michaels over on Amazon, so far a good experiment for Thursday nights or what?
I think the production has been excellent. I think they could use better games in order to keep Al Michaels perhaps a bit more engaged as a commentator, but he's excellent and historically excellent at that. But nonetheless, I think they've done well, and I hope that they'll expand going forward, because I've enjoyed the experience for sure.
Yeah, absolutely. I remember when Thursday Night Football was first rolled out those years ago, people were like, who's going to watch football on a Thursday night? And then it was kind of some like iffy matchups for a while. And then finally, I mean, as with anything else, right? If the product is good enough, if you build it, people will come. And there we are on Thursday nights. It's appointment viewing, whether or not your team is even playing. If you're a fan of the sport, you got to watch. It's going to be an awesome weekend. I'm very hyped up. Go Giants, of course. Martin, thank you as always, my friend. Enjoy your weekend. Enjoy the games. And we got a lot to break down next week for earnings. I'm really looking forward to it. Thank you.
Thanks, mate.
You got it. All right, folks, that is going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. Let's go, G-Men. We'll see you next week.